Quick disclaimer before we start. This is for educational purposes only, not financial advice. Always do your own research and trade responsibly. Now let's get into it. Most traders do not need another indicator. They need one clear answer before every trade. Where is price most likely to react? And what would prove the idea wrong? In the next few minutes, I will show you 3 simple price action concepts that can help you answer that question. Reaction zones, liquidity around obvious highs and lows, and market structure confirmation. None of them predicts the future, but together, they give you a practical way to stop chasing every move and start waiting for a plan. The third one is the filter that can keep you out of many low-quality entries, so stay with me. First, reaction zones. On a chart, some areas matter because price previously paused, accelerated, or reversed there. Instead of treating one candle as a magic signal, mark the small area where the move began. Here is a simple example. Imagine EUR USD rallies from 1.0800 to 1.0880 in a strong move. Before the rally, price briefly dipped between 1.0800 and 1.0815. That 15 pip area is now a zone to watch, not an automatic buy button. When price returns, your job is to observe. Does it stall? Does it print a clear rejection candle? Does the lower time frame form a higher low? If yes, you have a structured idea. If price slices straight through the zone, the idea is invalid, and you step aside. For risk, keep it mechanical. Put the invalidation beyond the far side of the zone. Size the trade so a loss is small, and only consider trades where the next logical target offers at least 2 times the risk. For example, risking 20 pips to aim for 40 pips gives you a 1 to 2 framework. Why do traders miss this? They see a fast move and enter late. A reaction zone teaches patience. Wait for price to come to an area you already mapped, then demand proof. Second, liquidity around obvious highs and lows. Look at a chart and find a level almost everyone can see. A clean double top, a range high, or a previous day's low. These places often attract attention because many traders build decisions around them. The common mistake is treating the first break as a finished signal. Instead, let price show its hand. If price pushes above a range high, then quickly closes back inside the range. That is information. It tells you the breakout did not hold. Here is the practical checklist. First, mark the level. Second, wait for price to test or briefly move through it. Third, look for a decisive close back within the range. Fourth, use the nearest swing point as your invalidation, not a random wide stop. Say a crypto pair has been ranging between 62,000 and 64,000. Price trades above 64,000, but the next candle closes back below it. Rather than reacting instantly, wait for a retest and a confirming lower high. If the setup is clean, your target can be the other side of the range. If the follow-through never appears, there is no trade. Why do traders miss this? Urgency. They feel they will miss the breakout. Your edge is being comfortable with the possibility of missing a move. There will always be another setup. Third, and this is the filter I want you to remember, market structure confirmation. An uptrend makes higher highs and higher lows. A downtrend makes lower highs and lower lows. Before you trade a reversal, ask, has that pattern actually changed? Or am I just hoping it changes? For example, in a downtrend, price may rally several times and still continue lower. A stronger clue arrives only when price breaks above the most recent lower high, then holds that level on a retest. That is a change in the information on the chart, not a guarantee, but a cleaner reason to explore a long setup. Use a 3-step rule. Identify the current swing pattern, wait for a clear break of the most recent swing, then wait for the retest or a second confirmation candle. This may reduce the number of trades you take, but that is the point. Quality beats activity. Keep the same risk rule. Define your stop before entering and seek a reward that justifies the risk. A 1 to 3 plan means a $50 planned loss for a $150 target, but only if the chart gives you room for it. Never force a target because the math looks attractive. Why do traders miss it? They enter during the first bounce, before the market has changed character. Structure confirmation asks you to be late on purpose, and sometimes that patience is what protects your account. Let's recap. First, map reaction zones instead of chasing price. Second, Watch how price behaves around obvious highs and lows. Third, require a genuine market structure shift before betting on a reversal. These are not shortcuts. They are a framework for being more selective, planning risk before entry, and letting the chart do the talking. If this helped you see price action more clearly, hit like and subscribe for more practical trading education. I have also put a free group in the channel description with detailed documents and chart examples for these concepts. Drop a comment. Which of these three ideas will you practice first? Trade responsibly, keep your risk small, and I will see you in the next one.